spotlight on the IT sector. Yesterday, the Nifty IT sector was the worst performing index, down close to about 2.7%. Year to date, the tech index is down nearly 9%, and there are concerns that US tech spending on capex will come down, and therefore that could hurt the Nasdaq, and maybe there could be a spillover effect on Indian IT too. We have with us, and even at yesterday, of course, the NASSCOM summit is ongoing. To talk more about the IT sector and the outlook, Manik Taneja, Executive Director, IT Services and Internet at Axis Capital, is now with us on the show. Manik, over the last couple of days, we've seen Indian IT stocks correct. Yesterday, in particular, large, these mid-cap IT names like Persistent, Coforge, which have had a one-way run, have corrected even more. So what's happening? What's dented the sentiment in the last 1 week on IT in particular?
Good morning, Teema. I think a whole host of factors at play over here. And even after the recent correction, Nifty IT is still outperformed Nifty over the last 6 months and 12 months basis. The stocks that have been correcting more sharply are the mid-tier names, given the punchy valuations that they've traded at, and some amount of disappointment with the way some of the global tier 2 techs have reported over the course of last couple of days. So we had the likes of EPAM, Globant, and Endava report on Friday. And while the qualitative commentary essentially remains quite positive, similar to what we've been hearing from Indian IT, signs of green shoots related to North America markets, as well as verticals like financial services as a whole, which is very similar to what you've been hearing from Indian techs. I think the rate of change improvement is where there have been some disappointments. So the likes of larger companies like Cognizant as well as CAP, the extent of improvement that I'm talking about in calendar year 25 is about closer to between 20 to 300 bips on a year-on-year basis. While in case of tier 2 techs, there is improvement for the likes of EPAM. Globant is talking about a similar kind of a growth in calendar year 25 versus calendar year 24. So some of those aspects also feeding in terms of realignment that we are seeing for Indian tech names. And as I said, tier 2 techs are the ones which are seeing much sharper correction. They are the ones who created punchy valuations and are hence correcting much more.
Coforge is trading at 36 times forward multiple. Persistent is at 51 times, and it's still at a premium to the 3-year average. It's at about, Persistent is trading at a 33% premium to the 3-year average, despite the recent correction. So what are investors telling you right now when you speak to investors about the outlook on Indian IT? Because the picture, on growth front, at least things are looking a little more encouraging. FY26 could be better than FY25. So, how do you marry the growth versus valuation argument when you speak to investors?
No, so that's a constant debate that people have been having over the course of recent months, given Indian IT continued to do very well through most of calendar year 24 and where valuations have remained much more expensive compared to historical levels. Global tech services names in particular trade at discount to their historical multiples, trade at discount to Indian IT. So a lot of folks have been trying to essentially understand, especially for investors who could play tech services listed globally. They've been debating on this relative bets. Global tech services through the course of last 3 or 6 months had outperformed Indian IT. Even some of the names that I spoke about, EPAM and Endava, which fell very sharply on Friday and even on Monday, and have now given up most of their outperformance in the correction in the last couple of days. People are still debating about the extent or the rate of change improvement in FY26. I don't think so. There is a lot of debate around the potential for companies to possibly get to flat to higher margins in FY26, but it's the growth acceleration that people are worried about.
Your top picks in the large cap space are Wipro and Infosys. Now, Infosys is likely to have industry-leading growth in FY26, given the low base of what we've seen. But Wipro, it's done a fantastic job over the last couple of quarters in terms of stability. Things are picking up. They increased the dividend payout ratio as well. But tell us a little bit more about Wipro, because valuations too have gotten re-rated.
Sure. So when we upgraded Wipro a few months back, we pushed it to the top of our preference order in the tier 1 space. And Wipro as a company tends to do well once every few years. CY17 was that year, CY21 was that year, and we would reckon that even CY25 would play in a similar fashion. So a combination of factors, portfolio mix, which is far more attuned to discretionary. Think about Capco, think about the rising assets. Both those assets are playing on discretionary spending pickup. In addition to that, you've seen Wipro do a phenomenal job in terms of defending margins despite revenue pressures, and the most recent move around resetting their capital allocation policy. I would say the rate of change for Wipro going into calendar 25 is also positive, and which is the reason why we we put it at the top of our preference order within tier 1 peers.
And in midcaps, your preference lies with Emphasis and Zensar.
Yes,
And both these stocks have done well. So from here on, what do you expect?
I would say Emphasis, no. Emphasis hasn't done that well, and we upgraded just after the most recent quarter numbers, and stock has come off similar to other tier 2 names. But this is a name which is most leveraged to financial services, and some of the factors that worked against them through the course of last 24 to 36 months, in our view, will work to their advantage on a go-forward basis, and that's the reason for preferring Emphasis. And this is possibly, along with LTI Mindtree, maybe the only tier 2 tech stock which may be trading at close to last 3 or 5 year average multiples. So valuations relatively far more sanguine, and the likely expectations of improvement in FY26 on growth for them. You saw the kind of deal wins that they reported in the most recent quarter. They were fairly encouraging and should provide support to the expectations of improvement for the company on growth in FY26.
And Hexaware Tech, have you analyzed Hexaware Tech? It's relisting now. It had a okay opening, but since then it's picked up to about 800 rupees.
So we don't have formal coverage on Hexaware, and thereby may have limited opinion on that front. But this is a firm which has been far more consistent in terms of revenue growth profile. Certainly underperforming the likes of Persistent and Coforge on growth through the last 5 years. If you peel through the onion, they've done very well in terms of diversifying the revenue base. Almost client concentration is next only to Coforge amongst their tier 2 names. And in terms of cash generation, partially because of the ownership, they seem to be fairly consistent. So I would say logically this is a name which should trade on par with some of the mid-tier coverage.
Manik, thank you very much for joining in with your thoughts on Indian IT this morning. So